Hey everyone. So today I want to break down a most recent US acquisition that I just completed. Now, if you've been following me on social media, you might know that I just purchased a duplex in Springfield, Ohio, using none of my own money through a creative joint venture process. I want to give you guys a little insider's look on what that acquisition actually look like. So I put together a joint venture with a private partner, and in this specific joint venture breakdown, the private partner was the capital partner, providing the capital for down payment and financing, and I was the active partner who put the deal together and saw through the negotiations and acquisitions of this specific property. So let's dive into this deal and show you guys exactly what it looked for. At the time of purchase, this property had been on the market for $157,000. The owner then lowered his price $10,000 to a new asking price of $147,000. I made an offer and had the offer accepted at $135,000. Now, since we're Canadians buying in the United States of America, we are required to put down 25% down payment on a $135,000 purchase price. This down payment came out to $33,750, which meant our loan amount was $101,750. On this loan amount, we took out a DSCR loan. For those of you that don't know, a DSCR loan stands for Debt Service Coverage Ratio. When the bank is qualifying a Canadian investor on a US purchase, they know that they can't verify things such as credit history, US income, so they then provide the option of the DSCR loan. They just want to make sure that based on the rental value of the property, that the $101,000 mortgage could pay itself. The DSCR ratio, in order to qualify for the loan, must be 1.1. That means that every dollar that you owe on the loan, you must bring in $1.10. Our DSCR rate was at 9.25%. Now, I know what you're thinking. You're thinking 9.25% interest? That's massive. That's crazy. In Canada, the interest rates are under 4%. At the time of this video, the interest rates are at approximately 3.6%. However, let's break it down on what the mortgage and interest payments actually look like compared to the rental income. So when I did my calculations, I took into consideration that each unit could bring in $1,000 a month for a total of $2,000 a month in revenue. Our payment on this with interest came out to $873 per month. Our taxes for city taxes came out to $110 per month. The cost of the property manager to manage a 2-unit building for us is $170. And we had to obviously have homeowners insurance on this, which came out to $1,850 a year or $153. Let's do the math real quick. $873 for mortgage and interest payments, $110 a month for city taxes. It's $70 a month for a property manager to manage 2 units, plus $153 a month for insurance, comes out to $106 a month in carrying costs. Now, when I did my underwriting, I evaluated both rental units at $2,000. Which means that my projected cash flow based on my conservative underwriting was $694 a month. So even when I underwrote this deal conservatively, I was projected to make $694 a month of positive cash flow once everything is paid. That's not the best part though. You see, when the property evaluator went in there to appraise the rental units based on the condition, which by the way, this property that I purchased at $135,000 turnkey because I purchased it off of a seller who was a general contractor. Before selling this property, he put tens of thousands of dollars in renovations to make sure that he offered a turnkey product. Once the appraiser came in and did the evaluation, he let us know that the market value per unit was $1,200 a month, which is great news considering the fact that I evaluated the deal at $1,000 a month per unit of rental income. We now know that the market value for the rentals of both units is $2,400 a month. When I deduct my $1,306 a month in carrying costs, I'm still left with $1,094 a month in positive cash flow. So what does that mean? That means that after my mortgage and interest, my city taxes, my property manager, and my property insurance is paid every month, I'm left with $1,000 of positive cash flow every month. If we times that by 12, we're making $13,128 US every year on our investment. Just to give you guys a little bit more of a deeper look, our down payment alone was $33,750. On top of the $33,750, there were some closing costs. We had to pay processing fees, title fees, notary fees, broker fees, and closing fees such as the evaluator and the appraisal. This came out to approximately $9,000 more. Once we put down the down payment and the cost of closing fees, comes to $42,750 in all. That's what it costed my partners and I to acquire a $135,000 duplex in Springfield, Ohio. If we consider the fact that we're making $13,128 a year after putting in $42,750 to purchase this property, our initial investment will be recuperated after 3.25 years. So it'll take us just over 3 years to recuperate $2,750 investment that we put in after making $13,128. Now, a couple of positive takebacks from this would be, when I underwrote my deal, I used conservative rental values. Originally, I thought I was going to be making $694 a month of positive cash flow. After the appraisal report came in, I then found out that I was going to bring in, instead of $2,000 a month in rent that I had originally calculated conservatively, I found out that the market value for both rentals was $2,400. This allowed me to add $400 more on my positive cash flow at the end of the month, which brought up this number by $4,800 than I had originally anticipated. At the end of the year, we'll be recuperating $13,128 of positive cash flow upon a total investment of $42,750, which would allow me to have my investors recuperate their money in just over 3 years. This is exactly how I put together this joint venture structure and what this purchase in Ohio currently looks like. If you guys want to know more about how you could put together US acquisitions through creative structures such as joint ventures, just like I did, be sure to subscribe to this channel.